Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll sprinkle in my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics that I comment on. Let's dive in. Let's see what people are commenting on. You can find me at finding_finance, and you can find the website. That's where we have our community, finding-value.com. I still have a discount coupon code going on, LEAP, LEAP, if you're interested, 50% off the first month. Then it goes to normal pricing, and then I've got a bigger discount on the yearly memberships if you're interested. That's where I dive into individual companies, individual sectors, and stuff like that. So Peter says, oil set for a nice top line draw this week, utilization picking up. Cracks are surging, cracks or crack spreads, that's gasoline, refining spreads. Russian refineries burning and Cushing drawdown about to accelerate into spring. Taken together, very favorable setup as we exit maintenance. You will see material inventory depletion through Q3 in his opinion. And that does correlate with higher prices of oil. So keep in mind, guys, gasoline is going up from the crack spreads more so than the oil price. And I think that we're going to get a potential combination of oil prices going up on top of crack spreads going up, because we're seeing the refiners looking pretty good. And I think there's a couple of charts down below that may show that. Vlad says, and this is about FinTWIT. And I wanted to go over this because I am part of this to some degree, and I want to interject some opinions here. The worse the investment advice, the more followers they have. A very interesting study in Finfluencers back 2023, they analyzed the recommendations of 29,000 FinTWIT influencers and uncovered some compelling observations. A majority of Finfluencers, 56%, display anti-skill with their investment advice leading to abnormal monthly returns of minus 2.3%. Approximately 28% of Finfluencers offer valuable investment guidance, resulting in positive monthly abnormal returns of 2.6%. Meanwhile, 16% lack the necessary skills for beneficial advice. Interestingly, the more skilled an influencer is, the fewer followers they tend to have. The research indicates a strong negative correlation between the number of followers and the likelihood of an influencer being skilled. The study also found a strong negative correlation between an influencer's skill level and tweet frequency. In simpler terms, the more a Finfluencer tweets, the less likely they are to possess genuine expertise. Following the advice of anti-skilled Finfluencers often leads to overly optimistic expectations, as their posts tend to be bullish on most stocks. Anti-skilled Finfluencers are more prone to post positive tweets following positive returns and negative ones after losses, showcasing a reactionary pattern rather than informed analysis. These influencers are also more likely to engage with social momentum, often tweeting positively about the latest popular stocks and negatively about those expected to lose value. What can we learn from this? For quality financial information, it's wise to seek out accounts with fewer followers, those that don't sound overly optimistic, and those that don't frequently post about the latest market trends. Some red flags are large account size, frequent posting, overly optimistic rhetoric, and excessive focus on the latest, hottest stocks. And this is the skill and number of followers. And basically, this is your skill, and this is your influencer's popularity. Why do you think this is the case? I'm going to give my opinions around here because, well, that's exactly what I do with these things. So what I've noticed and why I started my YouTube channel is because I was listening to someone at work and he kept telling me, Meet Kevin says this, Graham Stevens says that. He says we're in a housing bubble. And I'm like, there is no way we're in a housing bubble with no freaking inventory. That just doesn't make any sense. So I started my YouTube channel because the big YouTube channels, in my opinion, were getting it consistently wrong. So that was my opinion of why I wanted to join it, is because I was like, I cannot put up with incorrect information out in YouTube. It's like these guys have no idea what the heck they're doing. But I also think that that is why a lot of people gravitate towards them, is because they can speak their language the best. And they are covering topics that most people are searching for. So the big YouTube channels, they aren't skillful, correct, to a most degree, but they're riding the wave of what people are searching. That is what they're doing. And I refuse to do that. I just don't care to try to get people and dupe them into anything. I think that's just wrong. But that's how you get followers. You can also be overly negative and get a lot of people to follow you because they're scared and they want to follow you because of how scared they are. And that's also, I think, a manipulative tactic to try to get subscribers and views. If you're really, really good at being an investor, here's the problem that you have with a YouTube channel, or maybe even being on FinTWIT. You're always liking assets that no one likes. So no one's going to search for those assets. That's what makes you incredible, is because you're thinking differently than everyone else. And in order to find really good entry points, you're doing things that are opposite of everyone else. But why would someone search for something that no one is in or is interested in? So becoming a really skillful investor is going to basically take you out of the crowd. But in order to grow a YouTube channel, you have to market to the crowd. And I think that's why you see a lot of very skilled investors not having very popular YouTube channels, or maybe FinTWIT in terms of Twitter, financial Twitter. I think that's probably the case. Also, I would assume that more skillful people at investing are probably a little bit more wiser. They're going to be a little bit smarter than the average bear, maybe not a ton smarter, but a little bit. They've got personality traits where they can hold on and they're patient, and they make a boatload of money that way. I don't know of any other way to do it. These guys that are trying to trade short term, they're not making money, in my opinion. They're probably losing money, and they're probably people that you don't want to follow. But guess what? People are lured into those that are doing short-term trading because they think that they can make money easily and quickly, and they jump into technical analysis only. In my opinion, I don't think technical analysis only that is going to be as good as a hybrid where you look at supply deficits, you integrate some of the fundamentals, and then you look for clues in the technicals to match the fundamentals. It's a way to unbiasedly look at something and match it all up and say, yep, this looks good. And I've got unbiased data backing it. It's just not popular. So there's my opinions there. JP Morgan economist, a secular housing shortage in the U.S. has thus far prevented a pullback in housing construction employment induced by spiked interest rates. Even after accounting for lags, we document below the housing starts and construction employment should already be quite a bit lower than where they are now. Now, that doesn't mean that it can't go lower. It just means that the low inventory has been keeping the housing market up longer and higher, even in the face of increasing interest rates. It just means that we have a gigantic shortage of homes. It's that simple. Don't try to overcomplicate all this stuff. Coming on back, we've got Michael. He says, I wonder what happened in 2022 that made central banks buy more gold. But seriously, nobody wants to have his reserves frozen next. What they did in 2022 is they basically stole money from Russia. And now everyone's like, I don't want to be in that same situation. let's go buy the real crap, the real backing, which is gold. Gold is on the periodic chart. It's an element on the periodic chart. It will always have value, and and that is what we found in nature to have value as money. I'm very skeptical of anything replacing it that can last the test of time. So things can do well in the short term, but that doesn't mean it's going to have a very good long-term record. Gold's kind of been there and built economies around gold, and they've crashed when basically the gold left the economy. it's that simple. Gold has been the most effective form of money and bank reserves of anything that humans have found. More economies have been built on gold than anything else. And when gold has been taken out of the situation, those economies have collapsed. They've been diluted to death and they have collapsed for whatever reason. Coming on down, Bitcoin's headed for a crash to 4K in the next 18 months. How does this guy know this? I mean, that's a pretty bold call. This is his apparent, his opinion. Double divergence, price hits higher highs, but the RSI is showing higher lows. I think it's lower highs, I think is what he means. That's a classic warning sign the uptrend's losing steam. The wave structure, Bitcoin just finished the final sub-wave of a massive wave 5. Next up is a sharp drop to wave number 4, in his opinion. Is this going to be the case? I don't know. I'm just sharing you what other people's opinions are. It would be insane if that actually does go to 4K. I will say that. That's what really caught my attention. That's why I'm sharing it. That's also why he's probably sharing it as well, is because he's trying to catch the attention of people and be careful of these attention grabbers. To put things into perspective, the ratio of commodity prices to the S&P 500 is near all-time lows. Time for a turnaround. Damn right it's time for a turnaround. Now, do I think that we're in the next commodity boom? I don't think we're in it yet, but I think we're close. I think we're very close. I think what's going to put us over the top, and it's probably going to come out this year or next, is going to be a shortage of energy, in particular oil. That's what's going to kick us off. It kicked us off in 1970. It kicked us off in the 99, 2000 era. And we could very well get a slowdown after it kicks off. Like, we could get oil to rip it, and maybe we get a recession. That's very possible. I'm not stating that. Well, here's the move higher. Oil was a big driver here, and then we pulled back in 2000, and then we kept ripping higher. So I think that could potentially occur again. A very similar setup to the 2001 tech crash. We could be basically in the same setup here very soon. No real growth, just currency devaluation. This is also another indicator of what potentially is coming. In 1929, 1967, 2000, and 2023, we all have these downward moves where gold is starting to outperform the S&P 500. That is the beginning of the commodity bull market. I think that we had a nice big move from 2000 to 2008. We've come back up, and we just starting to roll back over, which is a leading indicator of a commodity bull market that's coming, much like 1967. The bull market came in 1970, 69, 70. The bull market here came in 31. And the bull market here, it really took off in 2002. So if you add, the same amount of years, you add about 2 years to 2023, I think, or 2022, which is the peak, I think that's really when we're going to see it take off. So late 2024, early 2025 is probably my best guess where gold's going to outperform, and which we've started already, and commodities are going to outperform, oil and all the rest of the commodities. Kevin, this is Patrick. He says, a very rare chart setup for silver is playing out right now. Only the third time in 50 years. 10 more trading days to confirm silver's quarterly defined breakout. Hang on tight. So this is him zoomed in. You can see we're breaking out of this early breakout line. We've only had 3 times in the past 50 years have this occur and happen. You can see we have similar setups, A, B, C, and the MACDs, and how this is about to separate, which is a big move to the upside potentially for silver. That also correlates with a lot of the other data that we've been looking at, like gold outperforming stocks, et cetera, et cetera. A lot of the things that I go over in these on Twitter. Art says a shale well gets an 8% recovery rate. If that can be improved, the size of the prize is phenomenal. And that's Senior Vice President at Neighbors, which is a drilling company. AI promises faster oil drilling and even more U.S. crude supply is what they are talking about. Companies use AI to run drill rigs and predict broken pumps. Technology could slash costs and squeeze more oil from wells, which could delay the peak potentially for a little bit. I don't think it's going to be a complete game changer, but I think it could maybe delay things. But it will also increase the profitability of drilling companies. But you also have to keep in mind, we've drilled the tier 1 wells already, and we're going to start going down to tier 2 wells. The productivity on those are generally lower, but technology is trying to offset that decline in productivity. Small cap breadth is improving. By my count, it's the exact opposite. The percent of the Russell 2000s at 3 months highs are declining. We've got a larger percentage of Russell 2000 stocks at 3-month lows that's going up. And you can see that the chart looks like it's almost ready to top out. So in his opinion, the small cap breadth is not improving. It's actually declining. If the monetary base is increasing despite one of the most restrictive monetary policies in history, what should one expect in a recession? We probably all know the answer for that, but it's going to increase. It's imperative to own hard assets in my view. That's what Tavi's saying. You can see this thing working its way on up for the U.S. monetary base under a tight monetary condition. This is Howard Marks. That's who that guy is. He says, quote, he's a very good investor. The desire for more, the fear of missing out, and the tendency to compare against others, the influence of the crowd, and the dream of the sure thing. These factors are near universal. Thus, they have a profound collective impact on most investors and most markets. This is especially true at the market extremes. The result is mistakes, frequent, widespread, and recurring expensive mistakes. And that is ingrained into our DNA. To become a really good investor, you have to unlearn these things. You have to block out the crowd. You have to think on your own. And that's exactly what I teach on the website, is what are the traits that make you a successful investor? And then I show you how to implement it. It's exactly what I do. One correlation to rule them all, this is gold price and inventories. Look at our inventory level on the COMEX inventories. We're basically at very low levels. I think this is 1,600, that's price. And then here is your inventory level. And we're basically at nothing in February of 2024. So guess what occurs? Higher prices are coming. Our inventory levels are drained. This is the perfect time to stay in gold, be long, and just ride the beast. Here's SILJ, which is the junior miners, versus silver miners, which is the larger companies. So SILJ versus SILV. And we can see a breakout here occurring. So this is, this is just the SILJ junior miners ETF, not the ratio I was thinking of. But we are starting to break out. Get ready here, boys. If silver starts to run, because remember, gold's already broken out. Gold's got low inventories. Gold, I think, is going to continue higher, but silver is right at that breakout line. If we break, I think SILJ is indicating that people are positioning for a potential move higher in the silver junior companies. Here's NDX. I just know that market often traps people. And this is what he's got. This is a trap. This is called a bear trap here. It squeezes on up, and this could be, in his opinion, a bear trap where you get trapped and they squeeze you to the downside. That'd be a bull trap. Bear trap here, bull trap up there. Is this a place you really want to be buying technology or selling tech? Selling tech, yes. Buying technology, no. Coming down, the true contrarian waits for things to cool down and buys stocks that nobody cares about. If you're really good at investing, this is exactly what you do. That's also what is the exact opposite of if you want to start a YouTube channel. It's very tough because you're going to be looking in spots that no one's looking at. And then people are going to argue with you. They're going to say, no, that's not a good one. It hasn't gone up for a long time. And you're like, that's exactly why I'm buying it. It hasn't gone up for a while. The ratios are cheap and the technical analysis patterns are bottoming. It's the exact time you buy it. The most amount of pain will come to the amount of people if this line is going up. They're not prepared at all. And with a lack of preparation comes violent unwinds and positioning. This will hurt the most people, and it is the outcome I am betting on. And that he's betting on commodities versus stocks ripping higher. You can also see the relative strength moving on up. It's exactly what I'm betting on. But no one's really betting on this, and it's going to hurt people when commodities go up and their cost of living increases, and they're not positioned investment-wise to benefit from it. Here's anus. Anus. Watch out, all this growth is dependent on oil and gas. This is an energy-intensive industry. So this is North African cement market expected to rise at almost 14% year over year on an annualized rate during 2024 to 2032. They're going to suck down oil and gas to build these cement areas in those in that continent, the North African continent. I said, oil company and why? The relationship between price and value holds the ultimate key to investment success. Buying is the most dependable route to profit. And I read that one last time. So that's where we're going to end it, guys. That's kind of what I'm seeing out there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got for now. So hopefully you guys are having a good day. Hopefully the markets are ripping. And we'll catch you next time. This is Finding Value.